If you're an options trader, there's a good chance that one of your go-to strategies is a vertical spread. A vertical spread is made up of two legs, one that is bought and one that is sold, with the same number of contracts in the same underlying, for the same expiration, and of the same type, call or put. The only difference between the two legs being their strike price. Today we're going to look at some misconceptions about vertical spreads and how in reality you could say that call spreads can be put spreads and also that debit spreads can be credit spreads. I know that seems like a contradiction, but stay here and you'll see what I mean and hopefully get a better understanding of how vertical spreads really work and how you can use them effectively in your own trading. We're going to start by looking at bullish spreads. As we know, there's two types of vertical spreads, debit spreads and credit spreads. In general, we can say that with debit spreads, when you initiate the position, you pay money and buy a spread that you hope by expiration will be at max value, which will happen if the spread is fully in the money. With a credit spread, on the other hand, you initiate it by selling it and receiving money because of it, and hoping for it to have a value of 0 at expiration, which will happen if the spread is fully out of the money. This means that you can have a long put spread and a long call spread as debit spreads, and also a short put spread and a short call spread as credit spreads. Notice here how in all these spreads, both options are out of the money when we initiate them. We can easily see which one of these strategies are bullish and which ones are bearish. We're going to focus on both bullish strategies now, long call spreads and short put spreads. When we look at this long call spread, the first thing we notice is that it's out of the money, since both call strike prices are higher than the current stock price. We also see the yellow line representing the profit and loss line at expiration, and the dotted white line representing the P&L at any time between now and expiration, based on time to expiration and implied volatility. This strategy is initiated for a debit, which is also the strategy's max loss. For the short put spread, we see that it's also a bullish strategy, but unlike the long call spread, this strategy is initiated for a credit, which is also the strategy's max profit. As we can see here, if time passes and the stock expires where it is right now, the long call spread will have a loss, so it has negative theta, whereas the short put spread would be at a profit, so it has positive theta. Seeing that these strategies are very similar, what will happen if we were to take both calls on the long call spread and move them to the same strike prices that the short put spread has? Both the P&L at expiration and the current P&L lines would be affected, and we can now see that they're identical to the ones for the short put spread. Also, notice how now both calls are in the money, so it's an in the money long call spread, whereas the short put spread has both options out of the money, so it's an out of the money short put spread. Also, notice that by both being identical in every way, they both have positive theta now. We can therefore say that an in-the-money long call spread and an out-of-the-money short put spread using the same strikes are identical in every way, making them synthetically equivalent positions. Now, let's take a look at an example so we can see how this is reflected in the market. We'll take a look at Facebook, which is trading at $268.40. And where we'll establish an in-the-money long call spread using the $265 and the $260 strike prices. We can see the prices of both calls and how we can initiate the position for a debit of $3. This means that the max profit and loss that we can have are $2 and $3 respectively. Max profit will occur when both options expire in the money, in which case the total value of the spread will be $5. Now, we'll look at the same setup, but for a short put spread, where based on the prices of both the $265 and the $260 strike puts, we can establish it for a credit of $2. This means that the max profit and loss that we can have are $2 and $3 respectively. Max profit will occur when both options expire out of the money, in which case the value of the spread will be 0. We can see here how these two positions are exactly the same. So yes, a call spread can be a put spread, as long as we're talking about a long call spread being compared to a short put spread and using the same strikes. Now, in the case of bearish spreads, we have something similar, where we'll take a look at a long call spread and at a short call spread now. If we look at the short call spread on the top and the long put spread on the bottom, we can see that their P&L graphs are quite similar. So we'll do something similar to what we did with their bullish counterparts. We'll take, in this case, both out-of-the-money puts on the long put spread and move them to the same strike prices as the short call spread. Now, the P&L graph will be exactly the same, making these two positions synthetically equivalent, with the long put spread being in the money now and the short call spread remaining out of the money. Notice how both these strategies have positive theta, because out of the money short call spreads and in the money long put spreads are synthetically equivalent. We'll also look at a real example here, looking at Disney currently trading at $197.16 and analyzing the $200 and the $210 strike prices for both calls and puts. Based on those calls prices, a short call spread can be established for a credit of $3.27, which is this strategy's max profit. When looking at the prices for both the $210 and the $200 strike puts, we can see that we can establish this in the money long put spread for a debit of $6.73, which would be the potential max loss, with the max profit being a max value of $10 for the spread minus the initial debit of $6.73, or a profit of $3.27, exactly the same as with the short call spread. We can also see here how these two positions are exactly the same. So yes, a call spread can be a put spread as long as we're talking about a short call spread being compared to a long put spread and using the same strikes. What are the main takeaways from what we've seen today? Today we've analyzed the main 4 types of vertical spreads, and we've seen how, if using the same strikes for long and short options, a long call spread is synthetically equivalent to a short put spread, and a long put spread is synthetically equivalent to a short call spread. You can see here how versatile vertical spreads are. You can create bullish and bearish strategies with either calls or puts, and also with either debit or credit spreads, which gives you, as options trader, a great deal of flexibility when trading them in the market. For example, if you have a long call spread open and want to close it, but liquidity is not that great because you're now in the money, you could buy an out-of-the-money long put spread with the same strikes instead of selling that long call spread. Also, a common misconception is that all debit spreads are short theta and all credit spreads are long theta. In reality, both types of spreads can be long or short theta, depending on whether their options are in the money, at the money, or out of the money. Finally, even though you can create your vertical spreads with calls or puts to achieve your desired exposure, you should always try to use out of the money or at the money options. This is because usually out of the money or at the money options have much better liquidity. If you're a new trader and want to know more about options trading, sign up to my options trading course on Udemy, where you will learn everything you need to know about options and options trading. It doesn't matter how much you already know about options. You will learn fundamentals and techniques that will certainly take your options trading to the next level. Sign up now to take advantage of a special promotional price using the code included in the description below, and don't miss out on this opportunity to become the best options trader you can be.